What a difference a bit of macro data can make. That's the story that we're following today here on Macro Money. I'm Ilya Spivak, head of global macro here at tastylive. Appropriately a little bit under the weather, so if you hear me sniffling, that's why. I'm leaking like a faucet here. But be that as it may, the show must go on. And so what we're going to do here is take a look at the wild reversal in financial markets that we saw today, as we have this situation with service sector ISM numbers coming in earlier and really giving a jolt to the markets all around, no matter where you look. So if you thought that macro event risk didn't matter, well, today is a great example to reconsider, because what we're going to go through and look at here is everything that was occurring with the release, why it moved the way it moved, and then actually just cycle through the major assets and see how that is going to impact not only near term, but also what it might mean going forward, because, of course, the week in macro risk is far from over. So, what did we see? Earlier in the week, we had the manufacturing version of the Economic Activity Survey from the Institute of Supply Management. By the way, as we look through these numbers, remember, these are structured as a PMI number, and so 50 is the center line. It is where there is neither growth nor contraction. It is the neutral line. Above 50 is growth. Below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. So earlier in the week, there was a great example of the robust state of U.S. manufacturing. That's the dark line that you see there. You can see the number coming in at 50.3, returning to positive growth, albeit narrowly, after a long stretch of contraction. So here we can see from about the middle of 2022, U.S. manufacturing has been shrinking at various rates. It seemed to find something of a bottom here in mid of last year, and the pace of contraction started to ease. The expectation, by the way, was that we would see in March yet another contraction, 48.4. The response, no, we're back to growth. And so, not surprisingly, the picture for the U.S. economy looked relatively bright. This followed a series of other better-than-expected economic releases, and generally, this gave the kind of confidence that the markets were looking for to say that maybe we don't need all of these massive rate cuts. Maybe the Fed is right in saying 3. The markets, of course, for their part, were anticipating 6 at the start of the year. And then came today. And with it, the service sector ISM number, which missed by a wide margin. Here we have the actual number, 51.4, against expectations of 52.7. And this was not a happy number whatsoever. If we look at what it represents, and we will in just a moment, and the internals under the hood of the headline number were even more worrying than the headline number itself. So, what did we see? The actual number giving us the weakest service sector growth this year, softest in 3 months. The last time that we were this soft, we'd have to go back to December of last year. Now, this is very, very important because services is overwhelmingly larger as a share of U.S. economic growth than is manufacturing. If you want to kind of broadly bucket where U.S. economic growth comes from, it's about 70% services, 20% manufacturing, 10% ag. So you have here a significant sign of weakness in the most important engine of U.S. economic growth. What you also have, interestingly, is a kind of convergence on standstill. So both manufacturing and the service sector have moved closer to essentially hugging that 50 line. This is not what you want to see. What you want to see is acceleration on both fronts. And of course, you want to see the service side in the lead, because that is the most impactful part of the whole. Looking under the hood does not portend great news. So here, new orders weakest in 3 months, echoing the headline figure. So the reason that we got this weakness seems to be an actual loss of demand in the service sector. Not good. More worrying still, employment. Notice both of these lines are under 50. So at this point, employment is contracting across the non-farm economy. Put that in your back pocket as we prepare to look at non-farm payrolls employment data on Friday. The March jobs report, of course, the most big splash macro release for the week. And the expectation here, leading into it seemingly, that we are shedding jobs for a second consecutive month in services, and for quite a while now in manufacturing, although we can see here the pace in the manufacturing employment side of things has become a tad less bad. The other thing is the price component. And here things get probably the most dramatic. The divergence here, unmistakable. The price component on the manufacturing side starting to really build higher and looking like the highest it's been since back in the early part of 2022. That probably reflecting the upswell in global commodity prices, which at this point are starting to outperform stocks a bit if you look at the aggregate indices. But on the service side, the side that the Fed cares the most about, what you are looking at is the weakest reading on the prices paid component since March of 2020, which is actually down here, the COVID onset low. And so you're looking at a situation here that really starts to tell you that perhaps you have the disinflation that the Fed has been looking for. There is, in looking at how this lines up with CPI, about a 3-month lead from this data and into the actual CPI numbers. So you have here a sort of precursor of disinflation to come. And this, perhaps, is how you might explain the response you see today from financial markets. Subtitle this part of the presentation, Macro Data Really Matters. Let's begin with the bond market. This is the 2-year note here, and this spike is the ISM report. Now, these are 15-minute charts that we're looking at. Notice, it could not be more obvious. Bonds were trading heavy into this release. As a matter of fact, there was a slight downswing earlier when ADP employment data, an estimate of private sector jobs growth, registered a hair higher than expected. So clearly the markets were quite sensitive. This is not the world's most telling indicator usually. And even just a slight surprise on the upside got the markets all ruffled. But if we look at what happens here, then when ISM comes out, that is about as loud of an exclamation point as you could imagine. Bonds rally, and they rally hard. They rally into the close, telling us that the markets looked at the soft numbers, looked at the weakness they implied, looked at the employment component, looked at the prices component, and said, well, this is why the Fed keeps saying they want to cut rates this year. Bonds went up, yields went down. It was the same story across the curve. Here's the 10-year note. Same thing. There's the pop from ISM. We close at the highs. At the very long end, where you might think, oh, surely the long end would be a little bit more insulated. This is the 30-year rate. How sensitive is it going to be to just one data point? Well, pretty sensitive. Here's the pop, closing on the highs. It did not stay in the bond market. Much to those of us that are relatively bullish on the US dollar, myself certainly in that camp, the US dollar got shellacked against virtually every major counterpart, save maybe for the Japanese yen. Here it is, spiking higher on the data against the euro, despite Eurozone inflation coming in weaker than expected, incidentally, as we anticipated on Macro Money yesterday, and setting the stage for the ECB to cut rates by close to 30 basis points more, in excess of a full rate cut than the Fed. And yet, nevertheless, the euro did not care. It rallied all the same as this data came out. If we want to take a look at the Aussie dollar to kind of get the dichotomy between how the dollar did against lower yielding, economically troubled currencies versus higher yielding, more business cycle anchored, higher beta, as it were, currencies, here's the Aussie dollar. Again, here's the data. Rapid rally. And closing on the highs. Where you have a little bit of sogginess is the stock market. Here is how all of this worked out for the S&P. The jump, of course, unmistakable. There's the data. But having spent a bit of time near the highs, the stock market ultimately fumbled and closed with a retest of its range that it established after the spike, but ultimately couldn't overtake it. So not great news here from the stock market. Maybe this reflects the weakness in the business cycle implied by this data. We'll have to wait and see. It is a similar story for the NASDAQ. Again, a spike on the data. We hold here for a few hours, slide, and when we come back into the close, we're left with a retest at the underside of this intraday range, and pointedly not the kind of closing at the highs, the kind of clear break higher that we see on an intraday basis anyway, in bonds, and certainly in currencies. In fact, what you see after the data spike is a series of lower highs for the S&P, a series of lower highs. So the stock market somewhat weak-handed here in response to this data. It seemed more like the bonds were celebrating and the dollar was getting pummeled as this data reinforced the case for Fed easing this year, whereas stocks said, yeah, that's good, but easing means something's wrong. and we're an earnings driven, business cycle driven asset class. This is not encouraging. So where are we then going forward? A mere 2 hours after this data, Fed Chair Jerome Powell spoke at an event in Stanford, California, here just about an hour away from where I currently sit, and said, look now, rate cuts are coming this year if our baseline expectations hold. We have no indication at this point, no confidence, that the recent pop in inflation readings is anything other than a bump in the road along further disinflation. There has, of course, been quite a bit more chatter about the idea that this is perhaps something that the Fed would have to abandon as the data gets hotter, the economy reaccelerates. The last several CPI readings have been on the warm side. But this ISM data certainly seems to suggest that, again, Fed is right, and the markets need to catch up. This was much the same sort of story as we had at the beginning of the year, where the markets said, we're going to need 6 cuts this year. And the Fed said, no, 3. That's this green line right here, 75 basis points. And as the data started to come in a little bit warmer, the market said, okay. Maybe we could do with 5. Fed said, no, 3. Okay, maybe 4. No, 3. And of course, the markets have had to adjust. And now we're in a place where the markets are actually on the hawkish side of Fed expectations, 50 basis points fully baked in. And at 61 basis points at the close today, it's a narrowly 55, 56% probability for that third cut. Perhaps the most interesting part of today's response, even though there were all these fireworks in the markets, is that this didn't change more. We didn't get very far in attempting to bring this back down, perhaps closer to 70, 75, as this data crossed the wires. Now, it is only one data point, but it should be eye-catching that we have now the market on the hawkish side of the Fed, and stocks have seemingly stalled. And it should also be eye-catching that as they have stalled, the diminishing stock of rate cuts has lifted the US dollar. As it was stalling, the dollar corrected. It then started to build back up again and clearly suffered a major setback today. In parallel, the Japanese yen suffered a major setback today, though it tends to move inversely of yields, and yields were down. The message here seems to be that the market is primed for risk aversion. When the dollar and the yen are moving together and stocks can't make hay of what otherwise screams good news in every other asset class, and those stocks respond, they ultimately drag their feet. This seems to suggest that perhaps the market is wondering whether to really extrapolate any of this, and wondering whether what we're looking at is an economic cycle that's turning over. And this is where maybe the price action today offers a bit of a clue about what's to come. That we had bonds meaningfully higher, that stocks couldn't make hay of this, all that seems to speak to business cycle concerns coming out of these numbers that we saw today. That the dollar got whacked seems a little bit off, but perhaps sensible as an initial reaction. And the question now is, does the dollar reconnect with its risk-off credentials here and start to find its legs because though rate cuts seem to have gotten some support from today's conversation and today's data, we still have a case where the U.S. is likely to end up with higher rates than all of its major peers. In particular, this calls into question the rally in the euro, where again, overnight, the data suggested that the ECB is well positioned to maybe cut even as soon as this month. And so this rally starts to look questionable. So the big question we're going to be asking ourselves now is this pullback a buying opportunity? And is this one a buying opportunity? Now, of course, catching a falling knife is not anybody's idea of a good time, but that's exactly what I'll be looking at in the days ahead. And that is macro money for today. Apologies for the flashing video there. That's me attempting to keep my congestion in check as we discuss this. I'll be back tomorrow. As ever, we're here Monday through Thursday right after overtime, a show that I co-host with Dylan Radigan and Chris Vecchio. Back on with Chris on Friday for Futures Power Hour. On with Victor and Tom for First Call on Sundays. Writing for the news and insights portion of tastylive.com and opining sporadically on the platform formerly known as Twitter at Ilya Spivak. Thanks very much for joining. See you tomorrow.